Hi everyone. Today we'll be talking about the case study analysis of our ACW1020 assignment 3. I am Q Xing Chuan, and these are my group mates Lim Xiao En, Cheng Yifei, Mandy, Zhou, Yi Heng Long, and Zhang Jiayi. Next slide, please. Now I'll pass on to Yi Heng to talk about task 1.
Okay, I will start our presentation. The case study analysis, and today will be analyzed SolarTech's financial viability using break-even and CVP analysis. Okay, next. SolarTech is a solar component manufacturer based in Penang. Although it operates in the renewable energy industry, the company still faces ESG problems, mainly high carbon emissions and lack of workplace diversity. To fix this issue, SolarTech plans several ESG actions, installing rooftop solar panels, improving energy efficiency, and starting diversity and inclusion programs. While these are positive changes, they also increase fixed costs, which can affect short-term profit. So in our task is to see if the company can still stay profitable after making this investment. Okay, next. Currently, SolarTech's fixed cost of 7 million ringgit. The variable cost per unit is 10 ringgit, and the selling price is 15 ringgit. That gives a contribution margin of 5 ringgit per unit. The break-even point is 1.4 million units, and the current annual sales are 2 million units, which gives a profit of 3 million ringgit. So before ESG costs, the company is in a strong position financially. Okay, next to Mandy.
Okay, first let's look at SolarTech after launching the ESG programs. Once these programs begin, the total fixed cost will increase to 9 million. This pushes the break-even point up to 1.8 million units. If the company continues selling 2 million units, profit will fall from 3 million to about 1 million. The business can still survive, but the safety margin becomes much smaller. Next page. We have two cost recovery options. Scenario A is increasing the selling price by 0.4. This will raise the contribution margin to 5.4 and bring profit up to 1.8 million. However, a higher price could reduce demand and affect customer relationships. Scenario B is keeping the same price but increasing sales by 12%. This gives 2.2 million in profit, which is better than scenario A. Still, it requires higher production and marketing effects, so it needs careful planning. Next. SolarTech can remain profitable even with ESG expenses. Comparing above options, increasing sales volumes gives better results than raising the price. So we recommend focusing on improving the company's ESG image to attract more customers while keeping price stable and controlling costs well. This helps SolarTech stay financially strong and socially responsible. Okay, next one.
Next, I will share more about the cash budgeting and ESG compliance challenges. According to cash flow assumptions provided as 2025 to 2027, we've computed the calculation plus cash receipts, less operating lines and surplus or shortage into the table below. It is clearly seen that there is a huge projected shortage in 2025. SolarTech's operation will be greatly hindered and will not be able to carry out all of its planned activities unless external funding is obtained. To add, the projected surplus from 2026 and 2027 will not be able to cover 2025's shortage. To find out why the company was willing and able to suffer a huge loss in 2025, it is not sufficient to just look at the years 2025 to 2027. Year 2024's data is needed too. So this is the realistic cash budget projection. In the table below, it is said that there is a surplus of 4 million in 2024, which allows the company to cover the huge loss of 3.4 million in 2025. Next, I'll be sharing more about the analysis of SolarTech's ability to sustain cash flow while pursuing ESG compliance. As mentioned previously, there will be a 4 million surplus from sales in 2024. This improves the financial capability of the company to fund ESG activities, especially considering the projected deficit of 3.4 million in 2025 due to weaker consumer demand. In 2026 and 2027, consumers will regain confidence in a firm's operation, and this can be reflected in a projected cash surplus. This surplus provides cushion should the firm require extra funding. Next, I'll pass on to my teammate Xing Xuan, who will share more about the potential shortfalls. 8 strategies to manage potential shortfalls.
Thank you, Chairman. So what are some strategies we can use to manage the potential shortfalls? So number one we can do is to have more financial clarity, control, and discipline. We can do this by tightening our working capital efficiency, such as by shortening receivable days or negotiate longer payable days. We can also implement strict CapEx prioritization by prioritizing the high impact spending. We can do so by delaying or scale down the non-essential ESG projects during deficit years such as in 2025. We can also update more frequently our cash flow forecasts by adopting rolling cash flow forecasting such as monthly or quarterly projection updates. Secondly, we can finance our ESG activities in phases. So we can stage our investments by starting with low-cost, fast ROI ESG actions first, such as the energy-saving initiatives with fast payback. Not only that, we can expand deeper into ESG initiatives in 2026 and 2027 for the surplus years after the financial stability improves. We can also leverage government ESG grants and tax initiatives, such as any green technology financing scheme that's available, that is already available. And we can also adopt pay-as-you-save green financing models to avoid heavy upfront costs. And finally, we can leverage the strong financial position as mentioned. SolarTech can take advantage of its strong surplus position in 2024 and projected recovery from 2026 onwards to negotiate a low-interest ESG or green financing. Financial institutions typically offer preferential loan companies with healthy cash flow and clear ESG commitments. By leveraging its cash strength and positive financial track record, SolarTech can lower its cost of capital, making ESG investments more affordable without straining operational liquidity. Next slide. Now I'll pass on to Jia to talk about task 3.
Okay, in the final part, we will look at the ethical and the sustainability changes faced by SolarTech company and how the companies can balance financial recovery with ESG duties. SolarTech was in the renewable energy field of phase 2K ESG problems. First, its carbon emissions are still high because it depended a lot on Malaysia's school-based power grid. Second is little workplace diversity. Only about 15% of employees are women, and most managers are men. This problem have created a gap between SolarTech's green image and its real actions, hurting its reputation and customer trust. Okay, next page. Okay, ignoring these ESG issues can bring serious risks. Some of solar teach global claims have when they meet and trusted if general particles are adopted. At the same time, many banks and investors now focus on ESG standards, making it hard for solar teach to attract new funding. If this problem continues, this company may lose sales, profits, and long-term growth. Next page. In short, SolarTech's case shows that ESG is no longer optional. It's vital for both trust and lasting success. To balance business recovery with ESG goals, and the company should include ESG in these plans, connect sustainability goals with recovery plans, cut emissions, use solar power or buy clean energy, support diversity, set hiring goals, offer mentorship and build inclusive policies, be transparent, report ESG results to rebuild trust and attractive investors. Okay, next one.
I will wrap up by talking about the choices SolarTech is facing. Our review shows that SolarTech is dealing with clear environmental, social, and governance issues. These include pressure to follow environmental rules and pay carbon taxes due to emissions, as well as difficulty attracting talent and keeping staff unit because of lack of inclusiveness at work. Money West. If the company only focuses on short-term gains and puts off ESG changes, it will face three risks: rising costs for following rules and carbon taxes, possibly losing investors and customers, and a long-term drop in market competitiveness due to a damaged reputation. Next page. Therefore, balancing short-term money recovery with long-term sustainable growth is very important. We suggest using a particle step-by-step plan. First, actively applied for green grass and tax breaks to ease early investment pressure. Second, see efforts like improving gender balance as investments in people and innovation ability. Finally, set up an honest reporting system to turn ESG progress into trusted brand value and win back market confidence. So we believe that investing in ESG is necessary for SolarTech to build strength and future competitiveness. It is not just a cost. This can help the company lower risks as policies get stricter and build competitive edges. This is our group's finding. We believe that finding a balance between responsibility and profit is SolarTech's only way to a sustainable future. Okay, next one.
All right, thank you. Now I'll make a conclusion for our presentation. So SolarTech must prioritize ESG, but with strategic and financially disciplined execution. As emphasized, not adopting ESG is no longer an option, but an investment must be carefully planned to avoid financial strain. Break-even, CVP, and cash budgeting enables proactive and data-driven decisions. These tools ensures decisions are based on financial evidence instead of reactive or short-term judgment. The company should balance ESG investments with liquidity protection and profit stability. Sustainability efforts must not compromise short-term cash flow or long-term financial resilience. SolarTech can leverage its current financial strengths to access low-cost green financing and government incentives. This reduces the financial burden of ESG initiatives while enhancing competitiveness in the market. The objective is to accelerate ESG transformation without jeopardizing financial stability. ESG should be fast-tracked, but not in a way that increases financial risk or operational vulnerability. And lastly, SolarTech must act with financial intelligence, ethical responsibility, and long-term competitiveness in mind. The company's future success depends on integrating both financial discipline and responsible sustainability practices. Next slide. So here are the acknowledgement of the use of AI in our presentation and assignment. Next slide. And thank you.